All right, let's dive right in. If you're a professional investor, you really need to hear this. The banking sector, it might seem okay on the surface, but the risks we saw in 2023, they didn't just disappear. Nope, they've evolved. Today, we're going to deconstruct the brittle backbone of the system and look at the exact vulnerabilities that could spark the next crisis in 2026. So, what's the single biggest risk? You might think it's inflation or maybe geopolitics, and you wouldn't be wrong, but you'd be missing the much more immediate threat. It's more of a mechanical flaw, a crack that's forming deep inside the plumbing of the financial system. Because the real danger here isn't one single thing. It's a series of interconnected risks. It's a fragile chain reaction where one link snapping can bring the whole structure crashing down. Let's take a look at the very first link in that chain. Okay, so the first and most tangible part of this problem is something we can actually see and count: this enormous wall of debt in commercial real estate, or CRE. And this isn't some far-off hypothetical problem. It's a scheduled event on the calendar. Just look at this number. In 2026 alone, a staggering 875 times billion dollars in commercial mortgages are coming due. That entire mountain of debt has to be refinanced in a world with way, way higher interest rates than when these loans were first taken out. And that brings us to this absolutely critical idea, the refinancing gap. Think about it like this. An office building was worth, say, $10 million, with a $7 million loan at 3%. Well, now, with higher rates and less demand, that very same building might only qualify for a new loan of $5 million. The owner has to somehow come up with $2 million in cash to fill that gap, or they default. That is the chasm. Now, this chart, this shows why this is so incredibly dangerous. The risk isn't spread out evenly, not even close. I mean, look at the difference. The average bank's exposure, it's manageable. But for over 1,700 U.S. banks, mostly those smaller regional and community banks in that at-risk category, their CRE loans are more than 300% of their entire capital buffer. For them, a wave of defaults isn't just a bump in the road. It's an existential threat. So what are these banks doing about it? Well, a lot of them are playing a game of extend and pretend. They just tweak the loan terms for a borrower who can't really pay, kicking the can down the road and pretending the loan is still perfectly fine. But this doesn't fix anything. It just hides the problem, letting the pressure build up silently. And that leads us right to the second block in this chain. This one is a little less obvious than an empty office building, but it's just as unstable. It's the structural weakness that's been hiding in plain sight on bank balance sheets. This number right here represents the paper losses that U.S. banks are currently sitting on. And we're not talking about bad loans. No, these are supposed to be the safest assets you can own. U.S. Treasuries, mortgage-backed securities that have simply tanked in market value as interest rates shot up. And here's the fundamental squeeze they're in. Banks are lending long, meaning they're stuck holding trillions in old assets that are paying them a measly 3–4%. But at the same time, they're borrowing short from depositors, from us, and they have to pay out a much higher 4–5% in interest. This negative spread is just crushing their profits, slowly bleeding them dry. And this creates something absolutely crucial, the lock-in effect. A bank might look solvent on paper, but it's dangerously illiquid. If they suddenly need cash, let's say to cover a bunch of withdrawals, they have to sell these so-called safe assets. But the second they sell, those $337 billion in paper losses become real losses, and their capital base just vanishes. They're completely trapped. So we've got the CRE time bomb ticking away, and we've got this hidden weakness on the balance sheets. Now let's add the accelerant, the gasoline on the fire. This is what makes a 21st century banking crisis so different and so unbelievably fast. I mean, we all learned this lesson the hard way in 2023, didn't we? A bank run used to be this visual thing, with people lining up around the block. Not anymore. Now, all it takes is a few viral posts online and a flood of transfers on banking apps. Billions of dollars can disappear in a single afternoon. Not days, not weeks, hours. And what's wild is that this isn't just driven by pure panic. There are two very rational forces at work here. First, people are just seeking better yields. They're moving their cash to get a better risk-free return on T-bills. And second, there's a regulatory delay. The stricter Basel III endgame rules, which would force banks to hold a much bigger safety cushion, they're not fully in place yet. The guardrails that could help are still being built. Okay, so we've got our three building blocks: the CRE maturity wall, the hidden balance sheet losses, and the incredible speed of digital bank runs. Now let's connect the dots and see how this chain reaction, this death spiral, actually plays out. Here it is, the play-by-play of how it all falls apart. First, the catalyst. The CRE time bomb goes off. Defaults start piling up, forcing a bank to recognize real losses, which eats away at its capital. Step 2, the amplifier. The market sees this weakness and immediately starts looking at the bank's other big problem, those huge hidden paper losses. Step 3, the trigger. Depositors sense danger, and they start pulling their money out with a few taps on their phones. And finally, the spiral. This run forces the bank to sell its safe assets to raise cash. The lock-in effect becomes a reality, the paper losses become real, and the bank's capital is vaporized. Game over. So, understanding that death spiral is obviously critical. But as an investor, you don't just want the scary story. You need a clear, actionable signal to watch for. What's the one metric you should be tracking? This is it. This is your early warning system, the commercial real estate to capital ratio. It's a direct measurement of a bank's vulnerability to step 1 of that death spiral we just walked through. It tells you exactly how much of their safety cushion could get wiped out by CRE defaults. And here's the magic number. It's 300%. The data shows that banks with CRE exposure, that's over 300% of their capital, are, statistically, the most vulnerable. They have the least amount of wiggle room. This is the red line. This is what separates the well-diversified banks from the ones that are basically betting the farm on commercial real estate. So the takeaway here is pretty clear. The key indicator for this fatal combination, CRE defaults, locked-in losses, and digital bank runs, is that 300% CRE to capital ratio. And that brings us to the final and most critical question of all. Of the 1,700 banks that are currently over that red line, which ones are on your watch list?